Discussions Roundtable. I'm Tom Nunemaker with our guest, Ron Bertino. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that out of the way, I will transfer the ball to you, Ron. Welcome back. It's been a little while since you've been a presenter on the roundtable. Ron's a great asset to Trading Group 2, and if anybody's interested in the recordings of the live sessions, they should check those out. But today we're going to be talking about your hedging strategy you've been working on, so I'm looking forward to hearing about it, Ron.
All right, great. Thanks, Tom. Thanks for having me as well. Okay, so this trade is something new that I've been working on. It's jokingly been called the space trip trade by Raul. I kind of said, all right, fine, let's go with that. Better than my boring names. And it's a bit of a play on a popular trade that we have in the community at CD is the road trip trade by Dan Harvey. And the name for road trip came about where he basically said that it's so easy to manage that he's happy to go on a road trip for like a week or something and not even worry about looking at the charts, right, or the trade. So as you'll see, this particular trade here is very, very hands-off. And therefore, Raul was kind of joking, saying, this isn't a road trip, this is like a space trip, right? You can go to Mars and back, and your trade will still be fine. So there's the name. Okay, so let's get into this thing. Now, starting off with the objectives of why the trade was created, right? I think it's important to kind of understand that because that will have an impact on how you look at this trade. So the first thing was I wanted something that took advantage of portfolio margin. And, you know, a fair amount of us perhaps, you know, trade with portfolio margin, but one of the things that became apparent to me was that I didn't feel that any of us were making proper use of that leverage. All right, so it's nice to have portfolio margin. Yes, you can do some things that you couldn't do in a Reg T account, such as, you know, selling naked options and so forth. But like if you're like most people, that kind of stuff of selling naked freaks you out. So therefore, it's not something you do. Right? So then you kind of say, well, really, what is the benefit to having this portfolio margin? I'm not really making that much use out of it, right? So I wanted to create a trade that would leverage the portfolio margin. And just by the way, to clarify, in case you're kind of saying, well, that doesn't fit me because I'm on Reg T, at the end of this presentation, I'm going to show you how to do the same trade types of setups such that you can actually do it with a Reg T account. Okay, so don't be put off by the fact that I'm saying that it's a PM, but that was one of the objectives of why I kind of created this, right? Second thing was the wanting to scale up in size of my traditional at-the-money style trades, right? Be that whatever that might be, M3, Rhino, all the other variations that are out there, okay? But some kind of at-the-money structure. And part of that, though, is that when you basically look at the market here and you see that the market, at least in my opinion, is changing its character, right? We're basically moving through to a very highly volatile market. And in my opinion, we've already transitioned into a bearish market as well. So I wanted something that could deal with that aspect of the market, okay? Now, if I am going to be scaling up in size with my at-the-money style trades, then the one thing that kind of freaks me out a little bit is the concept of a black swan event, right? So a significant overnight gap that, let's call it, say like 9/11 type thing, right? Something like that happens, and next thing you know, you wake up, or, you know, when the market reopens, because remember the market was actually closed for a number of days, right, during 9/11. But when the market reopens, you may find that the markets are down 10%, 15%, whatever that might be. Okay, so if you have a traditional at-the-money style trade, and you get a gap such that you cannot adjust on the way down and you're down then 15%, then you are down pretty significantly, right? So if you're looking to scale up your trading, I think that's something that has to be in the back of your mind, right? In terms of saying, I don't want to get destroyed if you get a black swan, right? I want to be able to keep trading. So one of the things that people typically do is they try and protect their trades with the concept of teenies, right? So a teenie is a deep out of the money long put. So this is basically the concept of, maybe a 2 delta or something like that. But the key thing about a teenie is that it is theta negative, right? Which basically means that it kind of eats in through to your income, right? Of a traditional income trade. And the other thing is that it gets weaker with time, right? And I'll show you exactly why that happens visually. You'll kind of understand that a little bit later on. So those two things aren't particularly good, but they are good for crash protection, right? So in the sense that it's a 2 delta today, but if the market does then gap down by 15%, it's not going to be a 2 delta at that point in time, right? So it may jump through to a 40 delta, 50 delta, whatever that may actually be, and therefore it explodes in value due to that, okay? So I'm not saying that they're bad, right? I'm just saying that they're good for black swan events, but 9 times out of 10, it's basically kind of like a life insurance policy, right? You're only ever probably going to need it once, but it may be an important one time, right, to kind of save your butt. Now, the hedge that I was actually looking at, though, is the concept of reversing these two things, all right? So basically looking to see if it was possible to create a hedge that could actually be theta positive, right? It could actually help my income, not hurt it, and something that would actually get stronger with time, right? Because if you think about your at-the-money trades, due to the way that decay actually works, from a gap perspective, the gap risk a lot of the time can actually get higher, right? Because once the trade has actually started to decay, then your T plus 0, if you like, is centered much more at the money than it was at the very start of the trade. And then suddenly now if you get a gap, you actually lose more money than you did on day one. Okay? So I wanted a hedge that would actually, again, get stronger with time and was theta positive at the same time. So in keeping with this kind of point over here, right, that these two things have to be correlated, right? So the hedge itself has to be able to keep up with the size of whatever at-the-money style trading that I'm actually going to do, okay? So it needs to be able to scale as well. It can't just be something that works for small size but doesn't work as you scale up. Oh, and one last point, I want it to be free, okay? So that may sound ambitious, right? But as you'll see in today's presentation, I think we're actually going to get there. Now, this may seem a little unusual, right? But one of the things about building this particular trade is that this, there's, as the saying goes, there's nothing new under the sun, right, kind of thing. I have studied under many different people, and I'm absolutely borrowing things, bits and pieces from here and there from all these different mentors, and basically putting it into, a custom kind of package and adding my own little tweaks here and there, okay? So what I definitely wanted to do in this particular case here is to acknowledge the people and let you know where certain bits and pieces are actually coming from, okay, as we actually go through. And it's not just to kind of say thanks and, give attribution and all that kind of thing. I think it actually has an educational aspect as well, right, in the sense that you can kind of realize that even though, a particular trade, you may say, you know what, I didn't quite like that trade overall, but there may be a little gold nugget in there, right? You can take that little gold nugget and then put it with other little gold nuggets and build your own custom trade that does actually work for you, okay? So I was originally introduced to this concept through a crew called Random Walk Trading. So if you go to randomwalktrading.com, you'll find them. They came out with this book over here called One Strategy for All Markets, and it is essentially this thing that you see over here on the right-hand side. It's an out-of-the-money broken wing butterfly, such that the upside has no risk, okay? They tend to place it for even money, and you can see here that they basically try and place the structure at around 1 standard deviation away from at-the-money, okay? So this was how I was introduced to it. They're actually a really, really good bunch of traders. Unfortunately, not very good teachers. So we'll just leave it at that. Second thing was, as I was part of the Sheridan mentoring community, still am, There was a trader on there called Ali Pache. I'm not sure if I'm pronouncing that correctly, but if you do have access to Sheridan Mentoring, this is the date you want to look to, August 19, 2010. So it was from quite some time ago, but it was a really good presentation. And this got me even more interested in this particular type of structure. Okay, and you can see it's similar in concept. So no upside risk over here, roughly around 1 standard deviation away from the money. And the structure is a broken wing style trade, or it could also potentially be a kind of like an unbalanced Condor as well, okay? And then, of course, as time goes by, then we get this profit hump here, okay? And that's basically how you make money. So in terms of what I'm borrowing from here, again, the concept was, like I said, structure roughly around 1 standard deviation out of the money, little to no upside risk, and the management style that he actually had, I'm borrowing a couple of concepts from him as well. Now, for those of you who may follow Tony Sizemore, you may have seen that relatively recently he's starting doing more of these types of structures over here. And it's basically the concept of a bearish structure over here with a starting debit, okay? And this is something that you'll see that my kind of morph has, right? There's another variation there. Then we've got the parking trade here. Parking trade, you can see here, is actually a very kind of bullish kind of structure. But the thing about this that I liked is that they shop around for a credit spread, not based on delta, but based on being able to get a dollar credit for that particular spread, okay? And I'm borrowing that concept too. Last but not least, not to bore you with the thank yous here, but John Locke. I've learned a ton from John Locke. He is a master trader with butterflies. And but again, similar concepts, flat T plus 0, which I like. This is an at the money structure, not out of the money. But the adjustments that John Locke uses, I'm leveraging the triggers and some of the adjustments. All right, so enough of the thank yous, right? But again, big thank yous to all the mentors. So let's get stuck in through to this actual trade. All right, so sample setup. Now, this is a negative Vega trade, right? This particular version I'm about to show you here is a Condor that's out of the money. And since it's negative Vega, then in theory, from an options perspective, you can get a bit of a bump from the concept of setting this up when you get a spike in IV, okay? Now, so what we're going to do is, again, very similar to what I just showed with the parking trade, right? We're basically going to look for a 25-point wide put credit spread in SPX, right? Using the deltas that have the highest liquidity in SPX, right? Which is the 25 multiple kind of strikes. And we want to be able to be getting at least $1 credit for those, okay? And what we're going to be doing is we're going to be selling 10 of these. This is how I'm going to define a single tranche. It will basically be 10 put credit spreads, and we're about to add some debit spreads as well. Now, the debit spreads, again, similar to the structures that you've kind of seen that this evolved from, we're going to be going out through to 1 standard deviation, and we're going to be putting our hedges for, or the protection, if you like, for these put credit spreads by means of putting put debit spreads in front of them. And we're also going to stick to the same width, right? So still 25-point strikes, and we're also going to stick with the highest liquidity as well. Now, when we do that, if you've been following me for a while, you know that I'm a big fan of Toss Fall Smile. I think that from a projection of Greeks, it is, I think, at the moment, the most accurate. So that's what I've kind of created this design around, right? So what I do want is I want the overall position deltas to be slightly negative, right? Roughly somewhere in about -1 to -3 deltas for the actual position. And then I want that T plus 0 to cross behind the upmost long put. And I'm about to show you this visually, okay? So don't get too worried about the wording. Then one of the things that we want to kind of ensure that the trade is more or less in balance is that we want the upside risk, okay, so the expiration line on the upside, to roughly be somewhere in the order of about 2% to 3%, right? But basically no more than 5 maximum. If it's 5 or more, it's not balanced correctly, okay? And we are going to be starting off with a small debit. Now, from an execution perspective, you can do this conservatively, right? And that basically means you submit the Condor order as a Condor order, right? And you try and get filled. Now, full disclosure here, when I've been trying to do that, I've been waiting a little bit too long, okay? So I was waiting for, for some of these up to 2 days to kind of get filled, and I wasn't getting filled. And to be honest with you, I said, stuff this, I'm just splitting the order up. And I split the order up in through to the put credit spreads and then put debit spreads. When I did this, I got filled within like a minute, okay, at mids, right? I didn't have to go fighting for price or anything like that. So ever since then, for this type of structure, I've actually been using this, if you like, slightly more aggressive way of getting filled, okay? So put credit spreads first. As soon as put credit spreads are filled, you then jump in and buy put debit spreads. All right, so let's look at this thing visually, okay? So same steps. So the first thing that we're actually doing is we're going to be selling the put credit spreads back over here. So you can see that we're doing that, and we are making sure that we're getting at least $1 credit for that 25-point wide credit spread, okay? Now, again, you'll find that credit roughly somewhere around 6 delta, okay? But it depends on other factors. But the key thing here is basically make sure that you're getting $1 credit for that. So that's step one. Okay. So step two is we're now going to be getting the put debit spreads to protect our put credit spreads, and we're going to go out through to 1 standard deviation somewhere around there. So 16, 15 delta somewhere around there. And when you say, okay, so how many do I buy? Well, on average, you'll find that you'll be buying about 4. Okay. But the key thing when you're structuring this is to basically look at these other points, right? So what we're looking at is we want to make sure that our deltas are slightly negative. Normally, that'll be between -1 and -3. So now with this kind of balance of 10 to 4, we've got -1.82, so that's perfect. And the last thing that we're doing second last thing that we're doing for confirmation here in step 4 is we are ensuring that the T plus 0, which is this kind of purple line, right? You can see that T plus 0 crosses the 0 line here, right? Which is behind our upper long put. Okay, if the T plus 0 did this kind of thing and crossed here at that point, that's not good balance. Okay, we basically need negative deltas, but we need the 0 line cross of the T plus 0 to be at the upper long put or behind it. Okay, now if it's like this, all right, and the cross is somewhere down here, you've probably got too many negative deltas. Okay, so it should be relatively close through to that upper long put. And the final step for this particular setup over here, this step 5, is to ensure that the max reg T risk, so this is our max reg T risk, right? It's 15K. Now, remember, this trade is actually designed for a PM account, so you may think, why am I looking at reg T? Well, I'm just looking at the max risk in order to find a balance point for the trade, right, to make sure I don't have too much upside risk. So what I'm looking at is I look at the max reg T risk here, which is 15K, and then I look at what is the starting debit for the actual trade. Okay, so to do that, basically, if you in Tulsa anyway, if you kind of put your cursor kind of thing anywhere over here, and then you look down there, right, this thing will actually tell you what the expiration line debit is. Okay, so in this case, it was minus $190. So what we're doing here is we're basically saying, fine, well, what is $190 divided by our max reg T risk, which is 15,000, right? You do that, and basically that comes through to 1.3%, right? So that's good. Basically, this thing is in balance. It's roughly around 2%-ish. Obviously, the smaller it is, the better it is. And sorry, I've got some background noise. I don't know if you guys can hear that. Perfect time for them to do lawn mowing. But if this was somewhere like 6% or something like that, that is way too much. Okay, you need to restructure the trade, right? So closer to 2% or less is great. Definitely under 5. Okay, so that is how you set the trade up. Now, what's going to occur? And this is on day 1. All right, on day 1, it basically looks like that. So on day 1, what happens if you were to get a move down? Well, remember, you're starting with negative deltas, right? So what this basically means is that, based on this modeling anyway, you're going to be making a little bit of money, or at least not losing money on the way down, right? And I'll actually show you that I've been the perfect guinea pig for this, because I put on a whole bunch of these trades at the worst possible time, but with full knowledge that it could actually happen, because I wanted to actually feel reality, right? And I put a whole bunch of these trades on at the start of January, and you guys know what's been happening since then, all right? We've been going straight down, and yet these trades have not been losing money, okay? Now, of course, I haven't had time to build up a profit hump like this, okay? But the whole point of me wanting to test this thing live was, okay, if we do get a pull down, which we ended up getting, I wanted to make sure that I wasn't going to be losing money on the way down. All right, so what happens after some time is this. So basically here, we've got a trade that was originally 88 DTE, and if I fast forward to 30 days in, which is 35% of the trade's life, right? Then you can see that if you were to get a pullback over here through to 1800, you're basically looking at a $400 profit, right? And if you got a even bigger pullback down through to 1700, you're looking at a $800 profit. And this is only after 30 days, right? But here's the thing, right? This number is important, right? So that number there represents the amount of portfolio margin, okay? So if you basically said, well, I'm trading Reg T, and if I've got a 15K Reg T margin and I'm pulling $400 out of it, that's not that great. That's a pretty, crappy return, sure. But if you're now saying $400 out of this number here, which is your portfolio margin, right? That's a 38% return on PM. So 38% on portfolio margin, right? Which is not bad, right? If you get a pullback over here down through to the 1700, you're looking at a 76% return on portfolio margin after just 30 days, if you do get a bearish pullback, after this profit hump has had some time to mature, right? So that's the key. And this is, again, what I was getting at in terms of designing something that can take advantage of portfolio margin, right? It costs like nothing almost to put on one tranche. So per tranche, what you're basically looking at, and a tranche basically, remember, is 10 credit spreads over here and 4 debit spreads over here. I'm calling that one tranche. Doing that is roughly 1.1K of portfolio margin, right? Which means you can therefore scale this thing up, providing it's a safe structure, right? So if it is a safe conservative structure, you can scale this puppy up and now increase the dollar reward that you're actually going to get with a very attractive return on portfolio margin, okay, with a very conservative trade. After 60 days over here, we're basically looking at a profit hump that's even bigger, right? And by the way, if I kind of go back through to 30 days, notice what happens if you were to, this slice over here is minus 12% of price actually going down, right? So I kind of like to keep that as a reminder of what a 9/11 event could be, right? So if that were to occur, what's going to happen? You're going to be here, right? Yes, I know vol can kind of do funky stuff, okay, but this model vol small actually takes volatility into account largely. But the point is that you are not going to get killed when you get that, a gap that is significant. Notice over here, you can gap all the way down to here without losing money based on this particular model, okay? And that's after 30 days. After 60 days, it looks like that, and that profit hump is even bigger now. Now, of course, it shifts to the back, right? So originally, it was kind of like more like this, right? So yes, it is more bearish, but the hedge is taller as well, okay? And then as you'll see, as we go through this presentation, you'll see that I'll introduce you through to concepts like what I'm calling layering and various other things that will help you keep the theta high or higher in front of this particular hump as well, okay? So that is that. Now, there, before I kind of show you this live and we have a bit of a play, I wanted to show you this, right? So this is quite an interesting thing, which I'm hoping it's the first little gold nugget that you'll take away from this, if you haven't taken away anything yet, right? And so, all right, first of all, what is it? So in Thinkorswim, you've probably seen these things, but most people look at these types of charts for looking at IV and looking at skew and all that kind of stuff, right? But one of the things that's available through TOS is looking at the extrinsic, right? So very quickly, more for the newbies, right? An option is composed of both intrinsic and extrinsic value. The extrinsic value is basically the time value, right? And that is the portion that decays, right? The intrinsic does not decay, right? So if you just look at extrinsic and then we look at two lines, we're basically looking at two expirations. We're looking at June and then we're looking at March, right? So the difference between these guys is a 64% so-called decay of time, right? So if you're looking at that now if you look at what happens to an at-the-money option, right? So an at-the-money option will go from here in June, and the model is basically saying that by March, it's going to drop to here, okay? So this orange thing is the value of the time premium in March that's left, okay? But if we then look at this portion here, this basically means that an at-the-money option will have decayed by 40%. Of course, on the assumption the market hasn't moved, right? Which is unrealistic, of course, but hopefully you get the point, right? So the decay percentage between those two dates is 40%. Now, one of the things that hardly anyone out there teaches is that out-of-the-money options decay faster, right? Most of the time when you kind of see a graph of options decay, people have that typical, curve that you see this, and that's all they kind of explain, right? But they don't kind of show that within a single expiration cycle that there's variances between the decay rates of the actual set of strikes, okay? So something that is at the money is going to decay by a percentage which is smaller than if you start going further out. So you can see here, if you go to the 16 delta, I didn't just pick this randomly, right? This is basically where you would be placing your put debit spreads, right? Roughly at 16 delta, 1 standard deviation out. So these guys, the time value of these guys is going to drop, but it's going to drop by 73%, right? And which is, you might think, well, that's not good because these guys are my protection. Well, that's true, but if you then look at your 6 delta, which is this is where you'll be selling your 10 credit spreads, right? Then this is actually going to drop by a greater percentage, okay? So you're further away from the money spreads here are going to decay at a faster rate than your protection. This is the reason why this happens. This is why you get the hump, okay? Because the power of your back side here, the put credit spreads, start to decay faster than these guys here. So basically in another way of saying it, your put debit spreads basically get stronger and stronger, which is a reason why you're getting that lift in that T+0, okay? And to kind of get back to what I was saying before, this is the reason why when you go way out here and you buy your teeny, right, from an IV perspective, these things get killed, right? Because if the decay rate of a 6 delta is 83, if I was to go to a -2 delta, what do you think that's going to be? It's going to be in the 90s. You're going to be, I don't know what the number is. Sorry, I forgot to look it up, but let's call it, I don't know, pick a number out of thin air, 92, right? 0.3, right? So, but the point is that, your teenies from a time value decay perspective get clobbered, right? So, but again, I'm not saying that they're useless, right? What I'm saying is that the reason that they so-called explode when you get a black swan event is not because of IV, right? It is because it's starting with a -2 delta, right? Which means there's a 98% chance it will not expire in the money, right? But suddenly, when you get a massive drop down in price and prices gap down by 15%, well, guess what? That -2 delta is probably now, something different, right? It's going to be much closer to a 50 delta probably, right? Therefore, the value of this goes through the roof, right? It's a lottery ticket, okay? But it is not due to IV. From an IV perspective, from a time decay value perspective, it actually gets absolutely slaughtered, right? And this is why your teenies lose their power very quickly. All right, let's do it now. All right, so let's kind of flip to the platform and have a look at a couple of trades, right? And we'll see if we can set these guys up. All right, so here is TOS. Okay, so let's go over here, and I am going to actually, sorry, I'm going to switch to SPX. Get rid of this guy. All right, so you can see here I've got these structures set up all the way out through to December. Okay, I'm testing them all out, and this is what I'm going to be talking about later on about time layering. So let's kind of pick an expiration. Okay, so let's pick I don't know, say June, right? So this is going out a couple of months, and set something up. So you can ignore, all the stuff I've already got on. All right, but let's kind of set it up as if you wanted to set up a structure right now, right? So what's the first step that you want to do? You're looking to sell the credit spreads for $1, okay, 25 points wide. So again, it'll roughly be somewhere around 6 to 5 delta, right, somewhere in there. So I might start here, and I'm going to say, okay, what happens if I sell this guy and buy this guy? My credit, oh, look at that, perfect. All right, it's $1. Now, I didn't want it to be perfect, right? So I wanted it to be close. So here it's 85. You go, oh, no, not enough, right? Not $1. So you go up a strike, and that one's 90. That was 1350. All right, that's what I want. Okay, so basically I've kind of crawled around. Now the one that I'm selling here is the 1375, which is, well, in this case it's a 5 delta, but you can see it's very close to around 6 delta, 5 delta, somewhere there. Okay, so that there is my credit spread, right? So again, I'm kind of borrowing here from the parking trade, right, to kind of find where I want to sell these guys. Now I'm going to be selling 10 of these, right, for a tranche. Then, so that's step one, right? Step two, I want to now grab my credit spreads, right? Sorry, my debit spreads. Where am I going to place my debit spreads? I'm going to place them 1 standard deviation away from the money. That's going to be roughly around 16 delta, okay? So I'm going to buy a 25 point wide debit spread, okay? It's going to be roughly $3 something on average. And in general, I'm going to do 4 of these, okay? But I want you to keep an eye on this thing here, right? My delta. My delta is currently 4, so let me kind of show you that visually, right? So this is what it looks like now, okay? So 10 credit spreads, 1 debit spread, ugly line for my T plus 0, all right? This is very bullish. This is not neutral. This is not bearish, okay? So I need more protection. I need more debit spreads, right? So I'm going to bump this up to not enough, still positive. 3, not enough, still positive, even though it's pretty close, right? 4, and 4 is about just right. It is slightly negative, right? If you now look at that last scenario, though, where is the purple line crossing the 0 line? Well, it's basically crossing it very close to the upper long, right? Which is what we want. So we have slightly negative deltas. We have the cross of the purple line crossing the 0 line close through to here. Now, could you do 5? Yeah, you can, right? This is obviously going to give you even more negative deltas. The cross of the 0 line is over here, which is comfortably behind that. But of course, it's a trade-off, right? Because when you do that now, you can see that the upper expiration line has dropped more because you're buying more debit spreads, okay? So if you look down here at this number down there, you can see that's at 525, okay? So 525, and then if I look over here, I can see that my max reg T risk here is $13,000, right? So if I pull up a calculator and I say 525 divided by $13,000, that gives me a risk of 4%, okay? Now, it's under 5, but it's closer to 5, right? So I prefer them to be closer to 2 if possible, right? So now, if you were looking at a chart and you had a little bit of a market opinion and your opinion was we're going down from here, then absolutely leave this on. And I would do the same, right? If I was bearish leaning and I thought the market was going down, then yep, I'll probably go with 5 and be perfectly fine with that, okay? Now, if you were more neutral, okay, where you really don't give a damn which way it goes, right, and you want it to be flatter, then again, this is still showing slightly negative. The cross is basically very close here through to the upper long. From a ratio perspective, then, what do we have? We have $190 debit, and max reg T risk here is 15,190, right? Same thing, 190 divided by 15,190 equals 1.2%, right? So that would be a more standard type of entry, right? A 10 by 4 is a standard single tranche, and that's your setup, all right? So again, sell these guys, 10 of them for about $1. Then buy as many of these as necessary to get your delta to slightly negative and the T+0 crossing roughly where the upper long put is, and then check that your ratio of the percentage of this initial debit is somewhere around definitely under 5%, but as small as possible, as long as everything else is in order and balanced. Okay, so that's how you set it up. So I can do another one if you want, but this is a little pause point where we can take any questions on the setup. So any questions on the setup?
Dirk had a question about a huge IV spike in a crashing market. Could you show the T+0 with the IV plus 50%?
Okay. All right. First up, when you're okay. First of all, let me just do it and then explain something. All right. So you look at that and you say, "Oh, that doesn't look good." Okay. All right. Now the thing about that is that, and this isn't coming from me, all right? This is coming from, I was talking one-on-one with the developers of both OptionNet Explorer and OptionView as well, okay? And the feedback was that this concept of manually increasing IV is quite ridiculous, right? Two main reasons for that. The first thing is that the model that we're actually using, so when you're actually using TOS-Vol-Smile, TOS-Vol-Smile is already taking all of the IV information from here, from the actual chain, into account for the actual down move. Okay, so the concept of saying, okay, I'm moving down, therefore I need to bump my IV by 2 points, you do not need to do that with this model. So whenever you're talking about CEV, then which OptionView has and now OptionNet Explorer has and TOS-Vol-Smile leverages, you do not need to do that. Okay, so that's the first thing. Second thing, though, is that when you increase this number by anything, even by 5, right, what it does is that it grabs every single strike, the IV of every single strike, and increases them by 5 points, right? So if you know what happens when you get a big move down, the skew absolutely does not increase by 5 points across the actual chain. Does not, okay? Therefore, you are kind of confusing things by doing this so-called the old-fashioned way, right? Back when we didn't have CEV models and you had like individual implied volatility and blah, 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 sure, okay? That was a closer way to approximate reality by kind of trying to tweak the vols up and down by a couple of points, okay? But again, based on feedback from the developers of these advanced softwares, they both told me, don't even bother doing that because you'll get, really wacky numbers that actually don't make sense, right? I then went off and verified that myself with big moves down in price, and I found that by just going with CEV, I got more accurate results, even with huge down moves, than I did by trying to myself manually tweak it and say, okay, even if I knew, for example, that IV would pop by 10 points, I would pop it by 10 points manually and find that the numbers were very unrealistic, whereas if I just let CEV do its thing, it was much, much closer to reality. Okay. Now, that said, going back through to what I explained before, I set up a whole bunch of trades here on this date. Okay, worst possible time, right? The trades did not have a chance to build up a profit hump, and we went straight down, right, at a pretty vicious angle. Okay, and I can show you any of my trades, and you'll see that they're all fine. Right? Good question though, right? But yeah, it kind of things are different now that we've got CEV. Any other questions on the setup?
Let's see. Dennis asked, what is CEV? I think constant elasticity of variance, I believe. Yeah,
or volatility, depending on who you believe. Yep.
Let's see. Any other questions? Ray says, toss vol floats the vol skew plot.
Yeah, I don't think we should get into a discussion on, which software is better and whatever at this point.
Let's see. So Chuck says your 88 days to expiration, IV spike will affect shorter-term options more.
Yep, that's true. Right, weighted vega will affect closer expirations more than further dated ones. Right? And that's another big misconception about these structures, right? Where people say, well, you'd be crazy to go out to a year, right? Because you are so negative vega, right? But once you understand weighted vega, you realize that the impact to your IV change being a year out is like nothing.
See a question, did you do some back testing during a crash to support the feature of the vol smile model?
Yeah, I've had a couple of people basically do some back tests as well, and they've found that the trade basically really does hold up. But I encourage everyone to do their own testing, for sure, right?
Then Mike asks if the market rallies soon after you enter, does it lose its hedging factor?
Absolutely not, right? So what happens, the worst thing that can happen on the upside move, right, what's your risk? Your risk in this case is $270, right? Which is the distance between the upper expiration line and the zero line. So you can see the number down here, right? So you can see it's 270 bucks. The most I can possibly lose in this trade is $270 on the upside. Okay? Now what happens as this thing decays? If I move this thing forward by a month, that's your line. Okay? So, and I'll show you ranges as this thing goes by. So as this thing decays, so if I go through to March now, that's your line. Right? So even if price moves up and does something over here, you can see that the worst possible thing, even if it shoots to the moon and it goes to 2,400, the max you're going to lose on this trade is $270. Okay? That's without adjusting, right? Which I'm not suggesting that you do that, but that's your maximum risk, 270 bucks.
Right? Raul asked, can we put debit spreads lower than 16 delta?
You can do whatever you like. I'm just showing you how I'm setting it up, right? But basically, I want the protection to be roughly at about 1 standard deviation away. Can you do it closer? Can you do it further away? Yes. If you do these put debit spreads closer, in order to get this style of risk graph, you'll find that the initial starting debit is going to be larger. This is why they're placed at roughly 1 standard deviation now. It's a good balance point in order to have a very, very, very flat T plus 0.
A lot of questions. How much more do you have in your presentation, Ron?
Lots.
Okay, well, all right. So, for now, just keep rolling with the presentation.
Yep. All right. All right. So what I thought would be interesting is to kind of give a comparison here between the road trip versus the space trip. Okay. So if we look at the road trip trade, here, it basically starts off with slightly positive deltas, right, about 3-ish. This is a standard 6 lot, right? Starting theta is, 17. We're basically now saying, okay, what would happen if the market were to go down? So the standard rule is that when it gets through to the lower side expiration line, then at this point you can either adjust or just take the trade off. So if we go with the latter option, that would basically incur a loss of about $500, right? Not 353, because we're actually starting from 180 with this particular model, okay? So it's roughly a $500 loss, and then a gap down, right? If that were to occur such that you don't get the ability to adjust, would basically incur a loss of about $3,000. Now, if we compare that through to over here, you'll notice that we're basically doing a 3-tranche, right? So a 3-tranche Condor space strip here. And you look at the same stuff. So I did 3 tranches in order to keep the theta roughly equivalent, all right, through to the road trip. Notice that our PM margin is still very, very small, right? 3.1K here. And then if we get that moved down through to the same spot that you would take off the road trip, right, which in this case was 1800, then in this case you can basically see that you're up money, right? So you're basically up if that were to occur. And if you were to have a 12% gap down without the ability to adjust, you're basically now down $500 versus $3,000. Okay? So that's just kind of like a quickie comparison between the two. But what is interesting is not basically saying one or the other. What I think is interesting is saying one plus the other. Okay, so if we quickly look at that, you're now looking at a situation where you say, all right, here's my road trip, and after 30 days, which is typically the time adjustment point, right, that Dan Harvey liked to kind of say, all right, should I tweak it? It's going to have roughly a 250-point profit range, which is nice. Okay, so that profit hump builds up. Now, if we then compare that through to the space strip, right? The space strip starts off like this. Within 30 days, it looks like that, right? So you've got a larger profit range, but you can see that the profit range is mainly under the market, okay? So you might say, well, can I just do one plus the other? Sure, you can, right? So if I basically put these two things together, the first thing is that when I set up my 3 tranches of the space strip together with a standard tranche 6 lots of my road trip, the first thing that happens is that if you recall, the standard road trip starts with slightly bullish deltas, right? Roughly about +3. Now, when we have this structure behind it, that now balances our deltas down to -1. So it now does make this thing very, very flat, okay? So if you have a neutral bias, or you don't care to pick direction, then this is a slightly more conservative way of actually starting the road trip trade, okay, on day 1. Now, you are not really increasing your downside risk, notice, at all, for a very, very large range of price movement, okay? And then from a PM margin perspective, your PM margin for this combination is 4.4, okay? So it's still very, very low, right? So, but this is on day 1. So what happens when you now go 30 days in, right? You're now looking at a 385-point profit range with no touch, doing nothing, right? And notice that you've still got coverage to the upside, you've got neutral coverage, and you've now got a really nice chunk of bearish coverage as well. And again, no touch, right? So, and this is what I mean about trying to create hedges that kind of actually complement your at-the-money trades, okay? And get stronger with time. And don't cost you anything, right? Theta positive. So that's that. So the next thing to think about is saying, well, okay, we started off our structure here, right, such that our space trip trade is set up in the same expiration as our road trip trade, right? And it starts off like this, and it grows to that. And you say, okay, that's pretty nice, okay? But the thing to kind of think about then is you say, what if I had set up, this guy, my space trip, 1 month earlier, right? So if you had set up your space trip 1 month earlier, this is what it would look like, okay? So the second now that you're looking to set your road trip trade up over here, you're now setting it up with an existing downside profit hump that's already there, okay? And this falls into the concept of what I'm calling time layering. So that's another thing to think about too. All right, so management, right? So how is this thing? Most people always first want to know how is a trade managed to the downside, okay? As you've seen, this thing starts with negative deltas, and if you structure it the way that I'm suggesting, on a down move, it will, at a minimum, typically not be losing money because it's negative deltas, okay? And the range of movement down is pretty huge. Remember that you're setting this thing up such that your t plus 0 crosses where your upper long is. And that's 1 standard deviation away, right? For that entire expiration, not a one day standard deviation. That's like a 3-month 1 standard deviation, whatever it is that you actually set it up for, okay? So that's a long way away. Now, in terms of when do you adjust to the downside? So the downside, I'm basically saying if any of your starting trade criteria is validated, then adjust. What does that mean? Well, it means that if deltas go from negative to positive, that violates the starting criteria, so we should adjust. If our t plus 0 now crosses in front of the upper long, that violates the starting criteria, so therefore we should adjust. Or if prices come down so much that it's actually entered your structure, right, then at that point, again, that's violating our starting criteria and you should probably adjust. Okay? So basically, if it doesn't look like what it did at the start, do something. Okay? So what can you do? Well, a bunch of stuff. The first thing over here is that you can add a new tranche of this Condor hedge or space strip with that movement down in price. So what's happened with the movement down in price? Typically, IV has spiked, and guess what? It's a good opportunity to put another one on. Now, are you adding risk, right? You're not, okay? What I mean by that is that when you're adding this second thing, you're actually typically going to be making your trade even more conservative because you can structure it with maybe buying 5 put debit spreads instead of 4, right? And therefore giving yourself extra negative deltas on the way down, okay? And now you've got an even larger range of downside moves that you can tolerate on the way down. Right, so this is not martingale on the way down, right? Like some people do with managing credit spreads. So that's one thing you can do. Next thing you can do, clearly, you can add an additional put debit spreads. That's going to give you more negative deltas. You can roll down the actual structure, right? Or you could buy a bearish butterfly on the way down. Okay, so you've got multiple options there that you can choose from. So I have shown. Okay, yeah, so sorry, that last point here is basically saying if you did have that particular structure, right, and then, this is your t plus 0, right, and then you find that price gets into your structure, then I'm suggesting, yes, you should, in theory, kind of make a modification, but once you get, if you're more advanced and you're familiar with trading at-the-money style structures, well, guess what? This is now an at-the-money structure. It's rolled into it. It's profitable. So you're in dollars here, okay? And at that point, you might say, well, you know what? I'm just going to manage it as an at-the-money structure, right? So if this thing starts to move up, then I can potentially consider, adding another structure over here, or rolling my shorts up, or my longs down, whatever you like, right? Basically manage it like an M3 or a Rhino, and so on. Okay, but that's kind of more advanced stuff. For now, for conservative, just either take the thing off for a profit, or do one of the adjustments that I've mentioned over here. Okay. So I have these things here. I'm actually showing. These are not simulations. These are adjustments that I've made to live trades here. Okay, and I can actually show you pretty much all of them. But let's kind of go through a couple. So add a put debit spread. So we start with, this is how the trade kind of started, way out of here, right? Standard kind of structure. Then price started to come down on me, right? Because again, I put this at the worst possible time, right? Right before the big plunge. And you can see here that our deltas have gone slightly positive, even though they're still very flat, right? Now, could I not do an adjustment? Absolutely, right? This is, look how flat that thing is, right? But in kind of trying to just keep with the guidelines, I said, all right, fine, let's do something. So that something was to basically add an additional put debit spread over here. And you can see that that's now taken me through to minus 4.75 negative deltas, still very flat. Yes, my upside expiration line has dropped a bit, all right, but still very manageable. Okay, so that's put debit spread. Rolling the structure down, all right? So this is another expiration that I had that was actually closer in time. This is how it started. Then price again was plummeting down. Price over here, right, is basically very near to the structure, and once it gets, much further, then obviously I start slanting down, which I didn't want. The position was profitable with a move down, and that's important, okay? So basically, I said, all right, fine, I'm taking this thing off for a slight profit, okay? And then I'm just setting up another one. Now, this other one, my opinion at the time was that we were likely due to flatten out or potentially bounce, okay? So you can see here that I was happy to go with flat deltas. So this is 0.69, I think it says there, okay? But notice that my trade criteria is still pretty close. You can see how close my T plus 0 is through to that upper long, okay? Really, 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 really flat here, okay? So I was perfectly fine with that, okay? But this is an example of taking the structure off and just rolling it down. All right, here's one of adding another tranche through to the trade, all right? So this expiration over here started there, as we've discussed. Then price came down. You can see here that the trade is still looking pretty good, all right, at that particular point. But in this one's a little bit kind of different because you can see I still have negative deltas. Everything's looking perfect, right? So you may say, why did you actually adjust that? Well, my market opinion was that we were potentially near support, and I thought we were going to bounce. So at that particular point, instead of just making an adjustment to one of your spreads, you could add another tranche, right? So you can see here what I did. My original structure was this debit spread, this credit spread, and then the second tranche that I added was another 10 credit spreads here. But this time, since I was basically to be flat deltas, okay, because I thought we were near a potential bounce point over here, I said, you know what, I'm only going to add 2 instead of 4 put debit spreads. Okay, and you can see that my theta has increased up to 47. Is that 47? Sorry, 41 compared through to 6 in this case where I actually started. Okay, so you can add these things on the way down. This is what I call price layering. All right. All right, so management to the upside. So key thing here is don't be too quick to adjust, right? You need that profit hump to build up. You want those negative deltas to build up before you make an adjustment, okay? And normally it's going to mean allowing the trade to mature for a couple of weeks. Now, going based on John Locke principles here, if your vega turns positive or if your theta turns negative, then that is a potential adjustment point that you may want to consider doing something to the trade. Okay, and I found that that kind of John Locke criteria there is pretty useful for this trade too. So what can you do? So the first thing here is you can now basically, keeping things simple, is just sell another credit spread out of the money at around your 5 delta or wherever you're comfortable. Okay, and you want to make sure that you're getting at least a dollar credit for that, just like the same starting criteria, and just add one at a time, such that you don't violate the standard trade setup criteria. Okay, so if you have your trade and you've got the T plus 0 that looks, kind of like that, right? It's built up, and let's say price is, I don't know, somewhere around here. Then you can basically go in here and now sell additional credit spreads out of the money. What that's going to do then is that it's going to raise your upside expiration line, but at the same time, it's going to flatten your deltas a little bit, okay? Because you're basically, this credit spread is going to give you bullish deltas, right? So the key thing that I'm getting at here is that make sure that your trade setup still looks good, right? You still want position deltas to be negative or at a minimum flat, right? If your deltas have gone positive, you've transferred this hedge into a bullish trade. It's no longer a hedge, okay? Other things you can do, again, borrowing from typical things from like John Locke and various others, right? You can roll up some short puts or the entire put credit spread. So if you had your structure, you could grab the entire credit spread and basically close them out and then sell them off again higher up. Okay, and that's also going to bring more credit into the trade. And you don't necessarily have to sell all 10 of them again. So here you had 10, you may close these guys out and then sell 8 higher up if you wanted to. Okay. Adding another tranche higher up. As a matter of fact, I've actually got should have used this diagram, sorry. So adding another tranche, so price kind of moves up here, and as price moves up here, well, there's nothing stopping you from adding another tranche higher up, right? Now you've got 2 sets of profit humps under the market. Okay, and the last one here is the concept of saying, well, could you, let's say that, your profit hump has been building up kind of like this, and then you're saying, well, it looks like price wants to either go up or maybe even stall around here. Well, there's nothing stopping you from putting in at the money structure here. Okay, put on an M3, a road trip, whatever you're actually comfortable with, right? Your hedge is there. It's protection. If price were to gap or move down hard, then your hedge is going to help you. Okay. Ideally, what you want to do is get your upside expiration break-even line as this thing matures, right? So you sell, another couple of credit spreads or make any one of the adjustments that I've made, that I've suggested, such that your upside expiration line gets to 0, right? The second that you've got this thing up to 0, you now have on a free hedge, okay? And this thing will keep getting bigger and bigger, right? Then if price kind of rolls down, that's your money that you're going to cash in on for 0 upside risk. Do you have downside risk? Sure, but it's a huge way away in terms of gap risk. And then if you are moving down, you've got to go through your profit hump before you're going to take a loss, right? Okay, layering. So this is another kind of concept here borrowed from the random walk guys. Again, I like the concept, the little gold nugget. I don't think they teach it very well, but that's separate. So here is an example that they can start with a structure that is out of the money. They'll either do broken wings or unbalanced condors, whatever. But then as price moves, they start adding additional structures, okay? And it's kind of like trying to corner the market in the middle. So then price moves again. Now they're adding an unbalanced condor here. Price moves again, and now they're adding an unbalanced condor on the upside, right? But the point is to just keep adding structures such that you're creating, multiple profit humps, okay? So that's more or less what it looks like, right? So I like that gold nugget and basically thought, well, okay, fine, let's try and bring that into the trade as well. So the concept here of price movement layering is what I just showed you already, right? So you've got your starting structure over here. Price is, say there. Price moves down. I can add another structure here, right? Price then moves hard up. I can add another structure here, right? So you're basically adding multiple structures as price moves around, right? So that's the concept of price movement layering. Time layering is the fact that I might start a structure over here that's 6 months out, right? Now, one standard deviation is here, okay? Because again, that's how you kind of set up the trade, right? So what's going to happen is that let's say that now, let's make it a little bit more drastic. Let's say that this has not expired, but decayed by 3 months, right? So now that it's at 3 months DTE, what's going to happen is that your one standard deviation is now here, not all the way out here, because there's less time, right, if the market hadn't moved. So what's going to happen is that when that occurs, now that this is one standard deviation, well, I can set up a structure there, right? So this is what I mean by time layering. So as, basically on a monthly basis, more or less, you should be able to throw another structure on in front, right, following exactly the same trade criteria, right? And notice that your back structure is still going to have that profit hump. So as you're adding another structure in front, you're leveraging that as well, okay? So price movement layers, you can see here, I've got a range here of 260 points. I added, these are all live trades, remember, okay? So then I added my second tranche over here as price, actually, I think in this case came down, made my potential expiration tent a little bit wider, right? But then when I got another movement again, here's 3 tranches on, placed at different price levels, and notice that I've gone from 260 to 335 points for my downside structure, right? This is what I mean by adding layers on top, price layering anyway. Time layering is kind of hard to describe visually, but I think I've kind of hopefully explained it decently enough, right, in terms of what I meant by adding additional layers as you go. What you've seen me do, though, is I've set up these structures all the way out through to December 2016. Okay, so then as these things, and you can kind of see at least 4 of them here, right? You can see 4 expirations. you can see the huge profit hump that I've potentially got to the downside here, okay? And as time goes by, my T plus 0, which is this purple line, is going to get higher and higher and higher and higher, right? And as time goes by, I'm going to keep adding more and more layers, okay? At a ridiculously small TM margin, 1.1K per tranche, right? And I'll get them to the point, hopefully, that they'll become free hedges, all of them. All right, taking profits. Very simple stuff, right? Either close the whole thing out when you're happy with the amount of money that you've got from your hedge, or you can peel off some of them to lock those profits, or you can flatten deltas, okay? So similar to what I kind of said before, if you have something like this and price is here, then if you're happy with the profit, which should, again, be a pretty decent return on portfolio margin, right? Much higher than what you're probably used to, either take the whole thing off, peel a few of them off, or flatten deltas. By flattening deltas, again, multiple ways to do that, but you can do what we mentioned before, right? You can sell, additional credit spreads back over here is a simple way, and that's going to increase the upside expiration line and flatten these deltas out. And you'll basically be left with a T plus 0 that more or less looks like that, right? On the assumption that you're neutral to bullish. And then if price dances around over here, then as time goes by, this thing keeps building up, right? So then if you get that pullback, you're going to get even more. All right, so that's taking profits. And for exits, we have, I'm calling these conservative because you can clearly do whatever you like, right? But more or less, if you get through to a 1 month to expiration and you're in a so-called, riskier kind of situation, let's say that this is still flat and then it kind of peters off like this, similar to the example that I showed, right? So I had a very close expiration, I think it was my February, and started off looking fine, but then price slammed down, right? Since this structure wasn't that far away because it was only out in February, then my T plus 0 is still pretty flat, okay? So if you're in a situation like that, then clearly that's a situation you want to adjust, or in my case, I ended up rolling back, okay? But in most circumstances, what's going to occur is that you're going to set these structures up further out in time, and by the time that you get to a 1 month expiration, your line is probably going to kind of look like that. So if you are at 1 month to expiration, and this is still at 0, there's really no upside risk. So it's really up to you if you want to kind of peel that thing off or not. And I think I've pretty much explained everything else here. So the X's are really, really simple in this case. Okay, here we go. This is subversion number 2, right? So the concept of going naked, right? Now this is, it really is putting in a slightly different variation through to the actual structure, but you will have some naked risk, right? So danger, danger, right? Now, having said that, this second variation of the trade is, in my opinion, the safest way that I've ever seen to trade naked options, or at least partially naked options, okay? And I kind of want to share that. So again, very last attribution here I want to give here is through to the guys from Option Sellers. They kind of opened my eyes to the concept. What they like to do here is they sell very far out of the money, that basically goes 3 to 6 months out. They'll sell 3 short puts. Then if that gives you X amount of credit, what they'll then do is that they'll then look at half of that credit and then look for a strike to buy that costs that same amount, okay? So they're basically selling 3 nakeds and then foregoing half the profits in order to pay for protection, okay? And that's their 1 by 3. So when I saw that, I kind of said, what if we were to apply this concept to the structure that we've been looking at before, right? So that's what this thing looks like now, right? So what we're basically doing is we're still using a very kind of similar ratio, 10 shorts to 4 longs, right? And everything else is the same, right? So we're still setting up our shorts over here at 6 delta-ish, right? We're then going through to our 16 delta over here, and we're buying 4 longs, So these 4 longs protect our shorts. Okay. Notice the trade structure still looks extremely similar to the old structure, right? Extremely flat T plus 0, slightly negative deltas, very nice theta for the amount of contracts, and PM is 11K. Okay, pretty nice, right? So 12% gap down, as you can see here, no worries, right? Anything on the way down here, no worries, right? Everything is looking just, everything's looking good, right? As it was before. Same concept as before, just we've slightly tweaked the structure, okay? Now, 30 days in, which in this case I chose a 151 day out, this is June expiration. So 20% into the trade, we're looking at a 550 point profit range on the way down, right? So it's pretty large. Oh, the other thing here, notice that our Vega is positive, okay? So in this particular case, a move down, right, which would typically create a spike in IV, is going to help our position. But for those of you that follow John Locke, you'll know that once you're positive Vega, if you get a slow grind up, that can potentially make the upside a little bit more challenging. But this structure is very different to the concept of an M3 because your upside risk is so small. Okay, so you don't have to freak about positive Vega out as much as you would with like an M3, right, where you absolutely want to make an adjustment. All right, 40% of time goes by, and you're now looking at a 650 point range down, okay, with just a June expiration. And just realize what that means, all right? You have a downside hedge that covers you for 650 points down, right, after just 40% of the trade goes by. What if we go out further in time, right? This is June, which most of you would think is already crazy. What if we go insane and go to December, right? Well, the further out you go here, the structures are placed further out in price because one standard deviation for December is much further away than it is for June, right? So this is what a December looks like. So same concept, same trade structure, right? Notice now that price can gap down by 27% gap, and you're okay, right? Based on the model, of course, right? I'm not saying that there wouldn't be some freaky kind of stuff happening with IV, just based on the model. So that's that. Now, our PM margin for something like this is still quite reasonable, right? So 18K for this particular trade. Notice that we're in December, right? And with a December expiration here, still using the same standard tranche, we're looking at 36 theta for a trade that's out in December. Right? Now, what I said before, so in terms of saying, okay, where do I place these things? You can place them anywhere. You can see here, I've got structures everywhere right now, okay? But that's because, again, I'm trying to take advantage of the concept of time layering and everything else that I've described to you. But if you wanted to put a structure on and say, okay, I want to be extremely conservative. I want to be sure, well, I want to be reasonably sure that my gap risk, and let's say that you're basically saying, okay, 9/11 is more or less what I want to go with. So in other words, I want to be covered for a 10% move down gap, okay, and not get killed with this particular trade, right? Well, that's pretty simple because we know that with our structure here, right, our upper longs are where? They're at 1 standard deviation. Right? And we also know that the way that we set this structure up is that the T plus 0 needs to cross at that same point, right? So if you put those two things combined, then it makes it very easy to figure out where you should place these structures to cover your side for a 10% gap down without getting hurt based on the model, right? So how do you do that? Well, we know that the last price of SPX in this case, when I took the screenshot, was 1906, right? We know that, let's say you want to cover yourself for a 12% gap down. So you need a 229 point down coverage for your gap down, right? If that's the case, that means that you would basically look through the numbers over here on the right, basically say, okay, I need at least 229 points, and that's the one there. So you say, fine, I'm choosing the June expiration, right? And that's going to give you that structure such that if you get 229 points down, your T plus 0 is just crossing the 0 line, right? So that's more or less what I just talked about, right? So you can see here the different DTEs, and I've basically recoded that based on how much of a percentage out of the money these trades are in order for you to be comfortable, right? So in this case, we chose this expiration here. All right, I just thought I'd show what the risk graph looks like with individual implied volatility rather than vol smile. I always recommend vol smile, but just for giggles, you can see here that, interestingly, our delta is showing twice as large to the negative side. So instead of being 4.75, as Toss Vol Smile says, it's actually -8. All right, so you actually don't have the downside degree of protection that individual implied volatility would suggest. All right, Vol Smile is saying that it's actually -4. All right, ratio versus Condor is probably the next thing that kind of came to my mind anyway. So I said, all right, well, the ratio is interesting, but how does it compare through to the Condor variation, right? So I said, all right, well, let's size these things with equal PM margin. So this is what the ratio here looks like, right? Standard kind of setup. Everything looks good, in balance. Upside risk here of our upside expiration line is $1,600, right? Theta of 13, PM margin 10K, right? We look at the equivalently sized Condor, same PM margin, right? Notice that the theta over here is 25 versus 13. So that is one difference. But notice that the upside risk here is also quite different too, right? So the upside, the expiration line is actually lower pretty significantly from a comparison through to this one, through to the ratio. Now, after 20% of time decay, this is what our ratio actually looks like here. So the at the money now has a $600 profit, assuming price has gone nowhere. A 12% gap down, which is here, has $1,600 of profit. And the peak of the T plus 0 over here is at 1422. Okay. Now, if I then look at the Condor after 60 days, now basically you're saying, okay, our at the money, which is over here, right? If price went absolutely nowhere, now is significantly more. So 1350 versus 600, right? A 12% gap down through to here. We're looking at $5,500 profit, or even a move down, I should say, versus 16. So significantly more profit there. And the peak profit here is level 1518. Yeah, you can kind of see it's around there. All right. So you can see that the peak of this tent is closer than it is with the ratio. Okay. And actually, all right. So I've got this to kind of look at. So the thing though is that I still kind of get freaked out by the concept of being naked, right? So at least partially naked. So I thought, all right, what happens if we get just an insane gap down, right? Something crazy, right? So I thought, all right, let's go beyond this peak, right? Way beyond it. So you can see here that I said, all right, what would happen if the SPX here were to drop down through to a level of 1,000, 900 gap down, 900 point gap down, right? And the reason that I chose that as well was because it was behind the main structure of the Condor, which you'll see in a sec. But the first thing to point out is that at a price level of 1,000, your loss over here is 25K or 24K, right, with a ratio. With the Condor, sized with the same margin, right, if we go back through to the same price level of 1,000, which is, notice, it's beyond even the back of the structure, okay, way back over here. But notice that our loss with the same margin is 53.5K. All right? So in other words, we're comparing 24K to 53, right? So the risk of the ratio, believe it or not, is half that of the Condor. The risk of a partially naked down through to SPX of 1,000 is half the risk of a fully covered position, right? That surprised the crap out of me. So now to kind of compare this, the two structures, you recall that I said that the Condor creates more profits in this area, right? Why is that? Well, because, and I couldn't kind of layer this properly in TOS, right? But the ratio, if I kind of try to draw this thing manually, that's bad. It's kind of like that, all right? So it goes up through to 65% of the heights of my Condor. That's one of the reasons that it gives me less theta, right? Because the profit tent, it just isn't there. The other thing, notice that not only is it lower in tent size, but all of this over here is potential theta that's going to come in, right? So in other words, this is a very quick move up that gets us through to close to $100,000 level over here, right? This is the reason why then with the Condor, the T plus 0 builds up to a higher level more quickly in front of the structure than it does for the ratio, right? So in a nutshell, all right, so I've got this thing here. So I've got the summary coming up in a sec. So I kind of said, all right, my first thing was saying, all right, 24K versus 53. I said, all right, that surprised me, right? But the steepness of the graph over here of my ratio, this kind of looked steep to me. I thought, well, all right, well, maybe if I just go out another 100 points, then the ratio will lose more money than my Condor, right? And I found that it didn't. So I kept going. I said, well, another 100 points, then another 100 points, then another 100 points, right? So this is the table, all right? So notice that I went through to level of 1,000, which is what the graph that you've seen. This is a 48% gap down in the market. This has never happened in history, right? My understanding is that in 1987, the largest gap we had was, I think, 27%, okay? In history. This is a 48% gap, right? Now look what happens. If we keep going down, 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 the point at which the ratio has a bigger loss than the Condor is at SPX of 400, which means a 79% gap down in the market. This was another big surprise for me too. Thinking, well, how can a partially naked position be that much safer than a fully covered one, right? But it is. So I've got some slides here that kind of show you roughly, I thought, okay, if I look at the relationship here between, if I call this X, then how far is the downside compared through to my upside slope? It's a factor of about 2.4 in this case, just to kind of get an idea of where that point was, right? And then if you look at the Condor, you can see that basically the T plus 0 of the Condor has to, number one, reach its max loss point here of 150K and completely flatten out the T plus 0, right? Only beyond that point will the ratio lose more money than this, right? Which again, in this instance, is a gap of 79% down, which is pretty insane. All right, theta graph is more or less what I was alluding to before, right? That this is the theta graph of the ratio. Notice that the peak over here is at about 1100, where we get the most theta, and the most amount of theta we get is 90. If we then compare that through to the Condor over here has a peak over here that's much higher, much closer to the money, right? Notice that the other one was, I think it was 1100, right? So the peak of the ratio was down here, right? Notice also over here that we get this kind of downslope over here with theta as well, whereas you don't really get it with the ratio, right? And this is all on day one, by the way, right? As the profit hump builds up, the ratio is slightly more bearish than the Condor, okay? So it actually gets even safer as it goes by. So here's the summary, just in text form, that I've pretty much covered everything, I think, already. So the ratio has half the upside risk, the expiration line break even. It's got half the downside risk, this is configuring the trades with the same margin, right? Commissions are insanely cheap because you're basically putting on the trade. Here I was doing like a 5x2, right? So this is for $7, whole $7 for the ratio versus 280 contracts for the Condor, right? I've mentioned that the peak of the ratio is 65% of the height of the Condor. It peaks at about the back quartile of the Condor as well. So that's why, again, it has slightly more bearish bias. And it's got half the theta and produces less profit, especially closer to the money, right? So all up, I thought that was pretty interesting, right, with how these trades compare, right? We're getting to the tail end, just so you know. I know I'm throwing a lot of stuff at you, but I just wanted to share everything that I've done so far. So with the fact that the commissions were pretty significant with the Condor, I thought, well, what happens if we alter the wing width of the Condor? So the default over here is 25 points, right, as I've kind of shown. And you can see here that take note of, and by the way, I'm going to size these trades with the same theta, okay, to keep that kind of equivalent. But if you look at the margin is 21K, and we're looking at 560 contracts over here, right? So if I make my wing widths wider and I go through to 50-point wings, then notice that my contract size goes from 560 down to 280, right? Huge drop. And my margin goes from 18K down to 10K, right? So both my margin and my commissions get a lot better with that, still retaining the same amount of theta, right? If I keep going and I go through to 75-point wings, again, keeps going down. Contracts are less, PM margin is less, same theta. 100-point wings, right? Less. So with 100-point wings, we're basically looking at, we cut commission costs by 70% by going from 25-point wings to 100-point wings, and we also cut our portfolio margin, which is interesting, right, by 70%, going from 25-point wings to 100-point wings. Okay, that was another little kind of interesting aha moment for me, right? So if you kind of lay these things side by side, you can kind of see the structures look pretty similar, right? And as you'd expect, the 25-point wings, which is the blue line, is going to be slightly more, let's call it bullish, than the green, right? Because the green is, you can see here that you've got more downside protection over here, but by the same token, you're foregoing the upside theta, right? So as you then roll forward in time, you can see here that the blue line makes a little bit more money than the green line does in the front part, and then once you get to the back part, the bearish version, which is the 100-point, it makes a little bit more money than the blue line, as you'd expect. All right, but very similar style setups, and the fact that you can get 70% so-called discount on the number of contracts and therefore the commissions, and also reduce your PM margin by 70% is, I think, very interesting. All right, last thing here for this variation of the trade is another interesting thing that I found was that I showed you that I had a whole bunch of these types of Condor positions and a ratio actually as well on. And if I added up the margin requirement for each individual trade, that came up through to 21.6K, which is very low, right? But get this, when I then looked at my overall portfolio, so I looked at all of my XPX positions combined, and then looked at what my margin requirement was, it was 12.2, which is roughly half of what the software will tell you that each individual position PM margin is. Okay, so as good as this number is, in reality, if you're doing all of these positions on SPX, you can actually cut that in half, it appears. At least that's what my platform is telling me, right? So now your return on PM margin doubles. Okay, so I promised that I'd show people with Reg T that they could potentially have a viable option here, right? And that is by leveraging futures options. And this is we're almost there. We're almost at the the end, guys. So, all right. So I set up a very similar kind of trade over here using the E-mini. All right. The first thing to realize is that if you want an equivalently sized trade in ES compared to SPX, right, you need to double up on the amount of contracts that you're going to be setting up. Okay, so if on SPX you're basically selling 10 credit spreads and then buying 4, then if you're going to set this thing up on ES, if you want the same amount of theta, then you're going to be having to sell 20 and buy 8. Okay, now at least in my platform, with my account, I'm paying $1 a contract for SPX, but then what happens is that with futures, I'm paying $2.25 per contract. And since I now have to do twice the amount of contracts for an equivalently sized position, and I'm paying twice the amount of money that I am for my standard SPX trades, you can see here that basically that implies that if you do this in futures options, then you're paying 5.6 times the amount of commissions, right? Which doesn't sound great. But by varying the wing widths, like I mentioned, if you were to go from 25-point wings through to 100-point wings, then yes, you would cut your commissions down by 70% in SPX, but you would, of course, do the same thing in futures options. Okay, so that's going to get your commissions to a much more reasonable level by using wider wings if you do the Condor variation, right? But another thing you can do is you can do the ratio variation, right? The partially naked one that we talked about before, right? So this is either, -5/2, or this could be at 10/4, either standard configs, okay? And if you do that, the span margin is significantly better than the PM margin that you'll pay for in SPX, okay? So those things kind of combine and more or less zero out, in my opinion, right? So yes, you're paying a little bit more on commissions for futures options, but span margin, which a Reg T account is going to give you, is going to be significantly less than what I'm seeing for PM margin. Okay, and I saw just out of side of my eye there, someone saying that PM margin actually varies. Yes, it does, and this is one of the reasons that I like having the -12% down price slice here. Because roughly speaking, wherever this is at, this is going to be a way that they calculate for SPX anyway, your potential margin, right? So if at the money was here, if you then go down -12% and it was here, then whatever this comes to, this is what they'll more or less be charging you as a rough number for your PM margin, okay? But of course, you're never going to let the thing get to here, right? Of course, there could be a gap, okay? But remember, this is 12% down there already, right? So as this thing kind of comes down, you still have negative deltas all the way. It looks like your deltas are probably going to roll over around here somewhere. At that point, you're in the structure, but in profit, so do something. Take it off for a profit, peel it, roll it back, whatever, right? Okay, so here's just a screenshot with, I looked through, because I do want to diversify and potentially start trading futures options as well. And this, the ratio and the Condor seem like, I think, good potential trades to put on and diversify, because it really is such a hands-off type of trade, right? Leveraging span margin here. So I looked through all of the futures options, and these are the ones that seem to have the most liquidity. Okay, so hopefully that'll save you some time. One last thing, and this is the very, very, very final topic, is that if you are feeling bearish, most people tend to gravitate to something like a bearish butterfly, right, as one option, especially if you're a John Locke follower. You're probably doing it in RUT instead of SPX, but you can absolutely do it in SPX. So here, if I set up a standard bearish butterfly, standard config, 50-point wings, you can see here my delta is close to -7. Theta is, 18, but this is more of a delta trade, not a theta trade. My upside risk over here is minus 2.1K. And if you do get that bearish move, let's say down to here, right? If you do get that move, which you're anticipating, you're going to be making $300, right? So can you do that? Absolutely. But just giving you the realization that you could also do one of these Condor type structures, right? Where instead of doing the standard ratio of 10 to 4, you do the standard, you do one more extra put debit spread, right? So you're basically selling 10 spreads here and then buying 5 spreads here. What's that going to do? That's going to give you slightly more bearish deltas, right? But still a very manageable upside risk, okay? Now, if you compare these two over here, 6.8 versus 7, very, very close. Again, I tried to size these equivalently, right? Theta is less, right? 7 versus 18, but again, the bearish butterfly is more of a delta trade, not a theta trade, right? So that's, I don't think, a big deal. Vega, potentially, I'm not thinking about skew now, just purely Vega is negative. So on a down move, that's going to potentially hurt you. This trade over here is already Vega neutral, all right, which is interesting. And my upside risk of my bearish butterfly is 2K, and my upside risk here with this Condor structure is half that. All right. More importantly, what's the money, right? So if you do get that bearish move that you expect, remember the profit at SPX of 1800 was $300 profit. In this case, our profit is almost double, right? And you still have a trade on that looks just like all of your other hedge trades that you've got on. So therefore, hopefully now you know how to manage them, what to do with them, and it's not something new you've got to learn to trade. Okay, whew, we're done. So, sorry, I know I've been talking my head off and gone much longer than usual, but I just really wanted to share that with you guys so you can start playing with it. So,
yeah,
questions?
Thanks, Ron.
There's probably a billion.
Lots of questions. You covered a lot of them, like the Reg T stuff. Let's see. Anything we need to check out? I mean, it says theoretical models usually break down the edges of the data sets. So while the conclusions of the losses for large gaps down must be taken with a grain of salt, right?
Yeah, look, I'd recommend everyone still go ahead and do your own back testing, validate this, works to your liking, do it in option view and whatever, which I no longer have, so I couldn't really model it there. Everything that I'm doing here is, I've traded these structures before, so that's why I wasn't concerned with putting these trades on live. The reason that I kind of moved away from them at the time was because I was trading them in a Reg T account, right? So my returns were really small on a percentage of Reg T margin, right? So I wanted something that would give me better returns, so I moved away from these structures. But then when I kind of got my head in through to portfolio margin, I kind of started rethinking this, right? Because now, remember, a 15K Reg T margin now translates to $1,000 of TM margin, right? So now, if it is a structure that you're comfortable with in scaling up, you can get very, very attractive portfolio margin returns on these structures with a very conservative structure to start with.
Hey, Ron, have you looked at these in a low vol environment?
Okay, so when you're looking with low vol, one of the things that you can do is you can, so I've mentioned that the standard way of doing this is to sell, well, if you're doing the 25-point wide spreads, to basically look for a $1 credit, right? You can still do that. But if you are in a very low vol environment, one of the things you can optionally do, because remember, the $1 credit, you'll get that roughly at about 6 delta, right? And if you're doing the ratio, same thing, right? You're selling your options at around 5, 6 delta. But you've got a decent range between 5 and 10 where you can do your selling, right? And then you go 10 deltas higher for doing your buying. So if you're doing the ratio, you're selling 5 or 10, whatever, let's call it 5. So you're selling 5 options at, let's say, 10 delta if the IV was really low. And you're now going 10 deltas higher than that, so that's 20 delta, to buy your 2 longs, okay? Or sell your 10 shorts and buy your 4 longs, right? Whatever. But you can do that and basically have a range of movement between your 5 delta and 10 delta, and then go 10 deltas higher to buy your longs.
Another question about, do you have a limit to the capital that you invest, even as a multiple of the initial capital or in absolute dollar terms?
Right. Well, 2 things on that. The first thing is that remember that this was designed for taking advantage of portfolio margin, right? So and as I've mentioned, with setting these structures up where they're, let's call it at least 3 months out in time to start off with, then you'll typically have almost a 10% gap down risk with, in theory, no loss. So that's a pretty comfortable, conservative trade, right? And the portfolio margin on that's going to be roughly 1K for SPX. Remember then what I mentioned before, that if you've got a bunch of these trades on, the real portfolio margin for the entire set of positions then ends up translating to be almost half. So it's actually closer to $500 portfolio margin for a position that Reg T would charge you 15K, right? So huge leverage on this for an extremely conservative trade structure. Okay, so the answer of saying how big do you go, well, that's fully up to you. I can't tell you that. That's up to your own comfort level. But if you've got a structure that's very conservative, it's got negative deltas on the way down, if you've tested it on paper and live during a downturn and you say, yep, it looks okay, you could potentially scale this up.
Yep. Lots of thank yous. Great presentation. Dave asked, they suggest using ONE or option view for testing. I guess either one would be suitable, right?
Okay. This is one of the things that I've got in through to Andy, because when I set this thing up in Toswell Smile, it's showing me that everything is within normal parameters. So I've got the T+0 crossing the 0 line behind my upper long put. I've got, let's say, negative position deltas of whatever, -2. Everything looks good. I then grab that same position, put it into 1, and my deltas are like +3, and my T+0 crosses the 0 line in front of my long put, right? So, and then it gets back down through to which one's correct. So in the testing that I've been doing, especially monitoring on the move down, with this big move down, my positions have been holding up. Therefore, that tells me that it probably was more likely to be -2 deltas than it was +3, right? So I've given that through to Andy. He has acknowledged that there may be some issues potentially with far out of the money options, like, I'm going out to 5 deltas, and he's looking at that too. So for now, I'm sticking to my guns in terms of my personal belief that Toswell Smile is giving me at least the most accurate data. That being said, can you use option view or one? Yes, but just realize that there'll be slight differences through to what you're seeing in Toswell Smile.
And one last question from Jan. How do you calculate the ratio of this hedge with the standard M3?
The ratio for the hedge for the standard M3. Oh, okay. Remember, so when you're setting up either the ratio or the Condor hedge here, you're setting up a structure that has almost, extremely little downside risk for, a 12% move down, right? But what's going to happen is that as the position decays or goes forward in time, as DTE gets smaller, then that profit hump starts getting larger and larger, right? So in terms of finding a good balance point, it's really just a matter of, slapping on the M3 at whatever size you do, and then throwing on some Condors behind it, and really just trying to find whatever you think the balance point actually is. Now, I don't know if it's going to work out exactly the same, but when I did it for the combining this, space trip with a road trip, I found that I had to, for a single tranche of the road trip, which is 6 broken wings, I ended up doing 3 tranches using 25-point wings in a 10x4 config. So 10 put credit spreads, 4 put debit spreads. But the interesting thing on that was that the height of the expiration line of my Condors was roughly the same as the height of my road trip. Okay, so that may be something that I don't know if that's a thing or not, but the first thing that I would probably look at is, slap on your M3, whatever the peak of the M3 is, then put on enough Condors such that the top of the expiration line of the Condors, throw in sufficient tranches such that they're roughly the same height, and at a guess, that's probably going to be a good balance.
Great rule of thumb. A good starting point anyway. So we're definitely over. So many
Sorry.
staying on this long, and a really great presentation, Ron. Lots of food for thought for everyone.
All right, great. So I'll set up a thread in the forums as well, and if you guys have extra questions, we can talk about it there.
Great. And if you can just send me the slides, I'll get them posted with the recording.
Sure thing.
All right. Thanks, everyone.